Welcome back. Well, let's focus on the retail participation. And the retail participation has been something that everyone's been appreciating. And personally as well, most of your money goes into SIPs, which we believe that over a longer span of time, well, it'll hold well. The only fear is retail getting into a bit of a trap? And that's the fear, but that's been the case as well. If you look at the SIP numbers, well, beautiful looking numbers. In the last 6-7 years or so, that retail number, the SIP number that you're seeing, has moved up from around 3,500 crores all the way to around 21,000 crores, which is very, very encouraging, up close to around 6 times odd in 7 years. As a proportion of the total free float, Motilal Oswal, they have put out this note, which they have titled the Retail Rhapsody. And they have highlighted that, as a proportion of the total free float of Indian market capitalization, the DIs and the retail, well, their holding has gone up substantially from around 55% all the way to around 63%. Not just their holding, but even their participation has gone up, quite a bit. So in the last 10 years or so, the non-institutional participation has gone up from around 38% to around 52% or thereabouts. Some on the street would say, well, that's a little bit scary. But those are the data points that's put out by Motilal Oswal. You have the FII flows. They've been quite volatile. And that's been the case. If you look at the monthly flows, the FII flows, well, they've been all over the place. But the encouraging part is the DII flows. And in the first half of this calendar year so far, you just take a look at it. Well, the DII flows at the half-year mark are more than what we saw in the entire of last year. So the DII flows have been the key reason that have been driving this market higher. Since we have the retail support, the domestic flows as well, that's led to a relative outperformance. And that's why, the weightage on the MSCI index has moved up from the mid-single digits all the way to around 19%. Because when the markets move up, higher market capitalization, that's resulting in a higher weightage. The problem is, the question that people are putting out is, are retailers getting into a bit of a trap? At least as of now, that narrative that India's retailers, well, they buy at the top and they sell at the bottom, well, that's not yet happened. So as of now, it appears that that saying is actually reversed. And this time around, they could possibly get it right. The only problem is two factors. We've been talking about PEs and other data points. Just want to highlight India's market cap to GDP. As of now, it is at a relatively higher level if you compare with what we have seen on average of around 85%. So that's one data point. And the other one is the outperformance of the broader markets. Whether you look at the mid cap, you look at the small cap space, well, that's been where the big money is. And that's over a 5-year horizon that have put out these numbers. Well, in the shorter duration, that's in the last 1 year or so, well, it's been even more startling. So that's the big question. Retailers, well, they have been participating, appreciating that performance. But the problem is, are they getting themselves into a bit of a trap? Well, Gautam, let's come across to you and get your view on this. Everyone's appreciating this big retail boost. But in the past, we have seen that retailers, well, they buy at the top and then they sell at the bottom. But this time around, that's not happened because people have been calling the top for a bit. What's your view?
Again, look, it's great for the market and the economy. It's a source of capital for risk capital for the economy. Look, the way to think about it is we have seen big shocks to the market. There were COVID times, even before that, GST, etc. And we still, the chart you put out, the chart is still on the way up. So clearly, it's like returns feeding into themselves. They've got confidence, and that's what reflecting in them buying the dips right now. So looks set. You can't really argue against them stopping putting money in a hurry. There could be market corrections, but unless the market correction is really sharp, I think that's the wrong place to look at to anticipate a market correction. That will retail stop money, or put money, or they'll start selling, and therefore market will correct. That will happen again with a lag.
I think retail participation will only go up, right? I mean, for those who are there for a longer duration, personally as well, most of the money that you earn, it goes into SIPs, and we believe that the only way to play India is maybe by the stock market. So that explains the participation.
And many developed markets, it happens through saving schemes, retirement schemes, etc., which has been missing in India.
So in terms of the budget, right, do you have any expectations? Because that's a big event to watch now. And there is more fiscal headroom as of now, right? Because of the RBI dividend, because of the tax collections, etc. So what are the expectations? Do you think a lot of it has been priced into the market?
So yes and no. At a broad level, the fiscal room itself means we are in a sweet spot where we don't have to compromise fiscal deficit. And there's enough room to sustain public capex and still take care, I don't know how much, what, the political requirements to do some social spending. There's enough fiscal room. And look, if you look at past economic cycles, when the economic cycle starts turning, the tax revenues keep surprising positively. Like look at last year, fiscal 24, pre-election, there was no need for them to surprise positively on fiscal deficit.
Correct.
But they did. They just the tax revenue collection engine is working very, very well, and that reflects the economic cycle. So there is enough room for us to not be bothered about fiscal deficit or the budget. What would matter is the specific schemes and nuances for specific sectors, like do we do something major around EVs or manufacturing, which is a bigger push than we anticipate. Those are the things we'll be watching carefully rather than, okay, what scheme and what fiscal deficit number.
What about a capital gains tax?
Yeah.
Any tweaks to that? Will it come as a shock to the market?
So market has been talking about it, to be frank. Like we hear from investors asking us questions. The two things, look, every year pre-budget we hear this discussion. So it's not new this year per se. It's been there for the last few years. That's one thing to keep in mind. Second is, if it happens, despite market talking about it, it will definitely be a negative surprise, for sure.
Okay, well, we've actually run out of time, not out of questions, but thank you so much for joining us.
Thank you.
And have a great weekend. And to all of you, a good week for the market. The bulls are on top, but hopefully we'll continue all of that traction into next week. Thanks a lot for watching Editors Roundtable.